Hello, friends. Welcome to Nirmal. I'm Piyush Jain, and as a part of our budget series, we are bringing to our conversation on the markets, on the sectors. There have been a couple of announcements in the budget, how you should be really looking at them from the perspective of strategizing for 2023, or from a sector perspective, are the budget announcements, government spending, or government policies going to really give some momentum to particular sectors, if any sort of stock views. And for actually getting all that information, let me now welcome today our guest, Mr. Sunil Jain, Head of Research, Nirmal Bank Securities. Sunilji, welcome to the show.
Yeah, thank you, Pius, and good morning, and happy to converse with you.
Absolutely. So let's first start with the first question. Uh, from your perspective, market perspective, broader sort of investor universe, uh, how much this budget is really instrumental in deciding sort of how the 2020 is going to look like? Was it a non-event, or you would say that this is looking a good budget and also could provide the markets a good standing over a 12-month period?
Pius, at such nowadays budgets are not like earlier. It used to have a lot of informations related to different part of the economy sectors and everything. Nowadays, things are quite different. It's more of a become a economical document because GST is not there in this, and only custom duty some changes are coming. And also, this government, if you see, is not tweaking with the rates and everything on a daily basis. They want to keep things steady. And even in that case, if we see the changes in the custom duties are very nominal, some minor changes are there, so nothing to work on that side. But if we talk about the total economic point of view, yeah, they continued their policy of high capital expenditure, which was not expected by the market, so that has come as a positive. Like they want to continue for the investment mode in the coming period. And also they were able to manage the deficit also. So the deficit figure is also in line with what market was expecting. So with the limited deficit target what the market was having, and against that they were able to increase the capital expenditure. So both the count, it was looking good. And also apart from that, if we see the maths of the budget, that is also showing the credibility. They had not over projected most of the items, even if we talk about the growth, what they had assumed is also credible, and you can't put up a questions on that. Even divestment targets are, you can say somehow it can go up or down, but nothing very big alarming figure which has been put over there. So seems more of a stable and reliable budget. Uh, the the key thing here is, if you talk about the intention of this FM or government is to push for the growth, even at the cost of the higher fiscal deficit, which we are running since last 4 years.
Right, again, and we have seen those fiscal deficit numbers again being maintained. The target was met. There, a projection for the next year is around 50 basis point decline, 5.9%. And then again, year after that, we are still talking about 4.5%. So I think that is something which perhaps the bond market would have taken it home. And when I'm looking at those numbers, then I think that, okay, if this was not a sort of bond yield spooking budget, then actually I remember then what actually would the banks and NBFCs would be looking like as a sector, because there are three or four triggers in this budget. Number one, you're talking about a continued focus on housing. So again, that is the housing finance, a sector traditionally liked from a perspective of watching or tracking NBFCs. Bond yields, again, no negative surprise. So again, that is something which is a sort of tracker for the banks and the NBFCs both. And then largely we are in an environment where interest rates are continuously increasing. So this is normally a either an NIM increasing environment or at least a better environment for the financial sector. So when I look at the budget and the overall sort of environment, how you are now looking at the banks or NBFCs, and was it positive for the sector?
See, here one point to be noted that there are two forces which are running in opposite directions. Government want high growth, wherein Reserve Bank want slower growth because they got an object of reducing inflation. So, whenever government wanting higher growth with higher fiscal deficit, means they need to borrow a lot more money from the market. RBI can provide that, but RBI got different objective of keeping the inflation down. So they are not. They had suck up all the liquidity in the system, and now the problem is that the short-term bond yield, short-term CD rates are somewhere around 3.5 year high. So that is creating some sort of short-term issues for financial market, and we had seen some corrections in the financial market because of that. So, but what we feel that that is a issue of next 2 3 months. Generally, in the last quarter, that is the fourth quarter, there is a huge demand for the money from the corporates for their regular activity, which generally picked up very fast in the fourth quarter. So, to meet that requirement, the banks need to borrow from the in the CD market, short-term market, and that is pushing up these rates at a higher level. So these rates we feel can continue to remain high for next 2 3 months, but post that as the inflation is also coming off, and post that when the demand is likely to slow down, and also RBI can also infuse some liquidity to support this demand. We feel that we may remain sideways for one quarter, but if you look at the financial sector, specifically the banks, the outlook for 1 year perspective continue to remain very strong because their balance sheet has very strong balance sheets are there now. NPAs and all are behind us, and the growth is also there. Only thing, the issue is that we had seen best NIM in last quarter, that is third quarter, and from here the NIM will be coming off in the second quarter, in the fourth quarter.
Okay.
So, but that decline will be somewhere in the range of 5 to 10, or maybe maximum in some banks can be up around 12, 13 basis points. So that much, what I feel that with the correction in the market is already getting factored into. And we had seen financials, specifically bank has run up a lot in last 3 months. Most various banks has even prices has doubled also. So definitely we need some cooling period for these stocks, and we will be seeing a lot of people coming out of and booking profit and all. So what we see that the outlook is very positive for the banks from a 1 year perspective, but near term it can remain sideways because we had already seen some correction. So stocks can be what we see that whenever, because we are seeing a lot of volatility in the market. So if suppose the stocks come off in that volatility, one can start accumulating those stocks.
Right. So basically, the message will be that budget is positive. The credit demand is going to look positive, strong, but it's more about sort of expecting some stock prices coming off from the recent highs, and then actually perhaps could be a better time here. Um, and any sort of
Yeah.
pick if you want to name, like in banks or NBFCs.
So, see, in a larger bank, we like ICICI Bank, and we had in the past recommended HDFC Bank as well. Uh, but in the smaller bank, what we like is RBL Bank, which we had recommended recently. Uh, but apart from that, we had in the past also recommended Ujjivan Small Finance Bank. That also looks quite attractive. So about the recent pick of RBL Bank, what we see that the problems with the bank is now getting resolved, and most of their stress assets problems is now behind us. And their business model include almost around 50% from the high growth areas like microfinance and then a card business, which are growing very fast and are very high ROA business. And apart from that, the balance portfolio of around 40-45% is of the wholesale books that is also doing now out of stress and doing well. So the perspective for selecting RBL Bank is that the prices at which we are getting is comparatively cheap. It's somewhere at around 0.75 price to book value, adjusted book value. And
That's
there
very low.
are, with the revival of the economy, there are scope for the improvement of their books. One more thing is that they somehow stabilizing or changing their business model. They are expanding a lot of branches and all, and because of that, their expenditures are quite high in recent time, and that is likely to continue for another 1 or 2 more quarters, and thereafter the benefit of these new branches or new investment which the bank is doing will start generating return. And the cost to income ratio, which has moved up in the recent past, will again stabilize and start coming down. So that will also improve their ROA in the what we see in the next 1.5 year. So that looks
Okay.
good. Can be used for investment from a year's perspective.
Okay, so that's interesting. RBL Bank is something which is an interesting pick here. ICICI Bank also has been a very strong rank outperformer over the last couple of, in fact, actually the many quarters. So that's also something which has been highlighted by Sunilji. On NBFCs, is there anything like which you want to highlight? Because I was seeing from a two sort of trigger point of views. Are we looking at a sort of consumption-led theme in NBFC, or we are looking at a housing finance led theme in NBFC, where actually we should be really picking an NBFC if there is anything you like.
See, NBFC has underperformed in the recent past because they were not having the advantage of raising money cheap, and the banks were passing on, or the cost of fund for the NBFC were increasing faster, and the NIM for them was not expanding, or even in some cases it was coming off as well. So, if we see, the NBFC has underperformed the bank in the recent past, but what we see that going forward, once the interest rates get stabilized by the RBI in one, say, this meeting or maximum at the next meeting, then the cycle can change, and they will start getting benefit of the higher interest rate and higher cost of fund, and their NIM can stabilize at that point of time, and the real benefit of growth will be visible in the performance. The point is that here we like the as a basket we like, but specifically in recent past we had recommended L&T Finance. Specifically, more it's a stock specific recommendations, in the sense that they are changing their business model. It was more of a infra funding or wholesale
Yes.
banking, wholesale funding bank, NBFC, which now they are changing it to more of a retail funding, and they are running down their wholesale business. And this is happening since last 2-3 years. And now what we see, the point has come where the retail business will start showing higher performance as compared to wholesale, and quite possible that the retail business is anyhow they are doing very well. It's a more of a high ROA business, and once the overall share of the retail business is now already at 70%, and they want to take it to 90%. So that process, what we feel is time has come, like it will start going into the aggregate performance, and then their ROA and ROE will also expand because of that. So that looks good, and then definitely valuations are very attractive. At one time book, we are getting the quality bank, which is serving to more of a retail sectors. So again, this the bank, the NBFC is into more of microfinance, and then CV loans and tractor finance and all.
Sure.
L&T finance, that looks quite good, and valuations are attractive. So more of a retail focus, so which is having a high ROA business. So that looks good.
Okay, so LNG Finance is the pick coming from NBFC, and RBL Bank and ICICI Bank is actually what we are working with. Let's continue on the financial theme here, and let's talk about a sector where we saw a sharp reaction in the markets, and we're talking about insurance sector here. We saw again what happened in the from the market reaction perspective. We also saw again basically what was the reason for that. 5 lakh premium plus taxation gets applied, and what market does is actually things that perhaps is going to hit the business very badly. So my question has three parts here. Part number one, um, government has decided now to plug this sort of loophole, I would say, where taxation adjustments were being made through actual insurance premiums, and product was being actually sold like that. Was that product such a big trigger, and was the market reaction warranted? And number three, uh, is the correction basically which has happened, is that now making the insurance stocks much more attractive right now?
Uh, See, insurance sector, I can talk like what the government has done in this budget is given indication that the business which you should do, the business which you are in. So insurance business is more of a, you should protect the uh, you should give a take a premium to reward the insurer for their protections, not for investment. So they the insurance companies were using this loophole to generate return that is tax free, and which government has plugged the gap, and now uh, it will be coming back to more of their key business of insuring. So now I think government has given good indication to all these people that better to focus on your core business, and do that and grow in that perspective. So what we see that there is enough scope for growth in insurance business. These were the adjustment which need to be done to stabilize the business model, and which we feel with this event will happen. Now bank will focus more on their core business of insuring, and will come up with new products, and there is enough scope for penetration. So insurance is a sector where you can invest for next 3 to 5 years. So if you see that in that perspective, current corrections is a good opportunity to enter into the sector which is low penetrated and can grow at 15% CAGR for next 5 7 years. So in that perspective, yeah, it's the correction is giving an opportunity.
Right, and let me address any sort of concern from our viewers. Do you expect any sort of earnings downgrade or weaker earnings, like between sort of June quarter or September quarter, because of the new policy, the 5 lakh premium we just talked about, tax applied on anything which is a 5 lakh premium? Do you expect any sort of earnings, or even if now, do you expect any sort of major earnings downgrade happening because of that?
See, anyhow, these life insurance companies are valued on their embedded values.
Yes,
So
yes.
whatever the business they had done up till now, that is protected, and now and because of that, whatever the embedded value which has come has come. Now the point is that going forward from here, whatever the business they used to generate because of this nature of business will not be there. So we had heard from the managements of different uh, insurance companies that somewhere the contribution is anywhere between 5 to 10% of their total AEP. So to that extent, yeah, the value has got corrected, and we are seeing that somewhere the valuations are for some insurance is at around 3.5 times. For some, it is at around 1.5 times. So, if suppose 5% correction is there and 3 times you are giving embedded value multiple, though 15% corrections can happen. So 15% corrections we are seeing has already happened. So now the things are at par, and one can look for longer term investment, not for the shorter term. Yeah, the about your reply to the questions for next year earning, because up to in the March the earnings will be continue to remain strong because it is not discontinued immediately. It is discontinued from 1st April.
First April.
So March
Yes.
can continue to remain strong, but yeah, June from June onwards, yeah, if we start seeing year on year, there will not be growth, or there may be some decline also in some quarters.
Any
So
any
that
any top
impact will
any
be
top
there.
stock pick if you want to say any
See,
insurance that stock
uh,
if you
see, our institution team is has recommended SBI life insurance, and
okay.
they were bullish on that, and we feel that is a good choice.
Yes, and SBI Life Insurance actually has done well over the last 3 years. So that's the insurance theme. There was also again an announcement which was linked to market linked debentures, and we know that the income from market linked debentures actually that also is going to be taxed. For our viewers again, we already know again that there is a sort of stock exposure which is Anrati Wealth Management. So again, we know again there's sort of negative impact on the sort of from earnings perspective here. So we actually will
Yeah.
go straight away
So
now.
see, the government.
Please say.
So the government object was very clear that you cannot use system for avoiding tax. So you have to pay full tax, and that was the key theme in both the point.
Absolutely, and that has been plugged here. And now let's talk about, I would say, the sort of super focus of the budget. You already highlighted, you took the name, sort of investment heavy budget. And then actually, our viewers will be thinking that the government is spending so much, perhaps a lot of employment, a lot of sort of infrastructure. Should we actually look at the road sector, or should we look at the railways, highest ever capital allocated, or should we actually go for the defense, where also again a hike in the capital spending, uh, where actually we should be looking? So help us understand how it's looking to you, and perhaps which stocks or sectors we should be really spending our attention.
So if we take not only just this budget, before that also last budget, government has announced Gati Shakti program. In that, they want to reduce logistic cost substantially, and for that, even in the last budget itself, they had overshooted the investment which they need to do. So that is a clear focus area for this government, that they want to do something extraordinary in the logistics sector. So where both road and railway will come. Road, we had seen a lot of investment already happening, but railway, yeah, definitely it's a more of a opportunistic area where a lot of investment can happen. Now, there is a limitation of the stocks and all for these railway sectors. We see most of the companies are in the government domain. Anyhow, they are also doing. They are also likely to do well in the coming period. So that particular area looks quite positive, specifically related to railway, because there we feel the government will continue to focus for the next one to 2 years, where heavy investment can go, and they can uh, will work on reducing the logistic cost.
So when you say actually the focus should be on the railways also, should we be focusing on the wagons? or we should be focusing on like wagons could be the Titagar wagons or Texmaco, or should we really focus from the perspective of financing institutions? Like again, that could be rides, project consulting, or should we actually focus on signaling or the EPC companies, KNR, NCC, and there are like so many companies.
No, it's a basket of all things. It's not like you will push up one thing and won't push up the other things. Titagar Vegan already got large orders from the government, and we had seen the stock also running up because of that. And it's not like things are over for them, but yeah, since the stock has already moved up, one can wait for some price to get corrected and then only look for that. But the your key point is that which one to select. So what we see that it's a more of a basket play because it's a more of a industry tailwind. So one can look for two three stocks and then start playing on that rather than just a single stock.
Sure. And from a renewable sort of perspective, is transmission line the buzzword here? Are we looking at sort of a large transmission orders coming for the sector?
Yeah, see, anyhow, Power Grid consistently into this business, and also a lot of orders are coming from that. But the key thing is that to play this area, it's better to play it through the people who are either supplier or are implementer of these transmission lines and all. So we had seen the PAR coming out with very good numbers, and also KEC management is indicating that the worst is behind us because of the commodity prices ups and down. So things are likely to move up from here. Things are likely to improve as the commodity prices stabilize and the order booking is strong. So they can benefit in the coming period because of this transmission business.
Okay, so a couple of companies perhaps could be interesting to watch out for. Case again, as you just took the name here. From there, also wanted to discuss from a road perspective. Is that something which is still a focus, or between roads and
Uh,
defense? This time we should give more attention to defense.
See, looking at this way, road sector is not doing well as of now, mainly because two problems. One is in the recent past they faced a lot of cost inflations, both in cement, steel, and then also transportation cost because of the high diesel prices and all. And also the working capital cycle anyhow for these companies which are in the construction of the road are consistently high, and because of the high interest rates that cost is also increasing. So at such as current point of time going into the uh, construction companies which are constructing the roads and bridges is not so fancy for us. We are not recommending as of now
Okay.
to see to come up with on the capital expenditure side, we had recommended a few stocks in the recent past related to these things. More of a bottom up approach what we had seen. So in that first company is Sangvi Movers, which is a more of a crane hiring company. It's a different. It's not directly the capital goods company, but help it in implementation of capital goods projects like steel plant or cement plant or even windmill installation and all. So they are servicing to for capital expenditure what they are doing, and it's one of the largest crane hiring company in India and the fifth largest in the world. So they don't have small cranes. They have all 100 tons to 1,000 tons cranes, which are generally not we can't see them on a regular basis. So what has happened, like because of this capex cycle, their utilization of this crane has improved in recent past, and they are now somewhere at around 85-90% of their utilizations. and also the yield which is need to be seen in these type of companies also showing the sign of improvement, so that is also improving. So what we feel that going forward also there will be higher capacity utilization, and because of the somehow scarcity of these type of crane in this current environment, the yield is also expanding. So this will have a positive impact on their results in the near term, or maybe even a bit longer term of say from here to 1.5 year. So this company can benefit because of that. So this stock which we like, and the valuations are very attractive at current point of time at around somewhere around 5 time EV by beta. So that looks good. So we had recommended this stock in the recent past.
Okay, so Sangvi Movers is something which is really interesting. From there, again, if we go to the fishery sector, I'm now making a move from infrastructure to another new sector, fishery sector here. We heard again, and this has been over the sort of part of the last 3 4 years, where government actually has been trying to boost agriculture, fisheries, dairy sector, allied sectors, and fishery is one part of that sector here. And we have seen some efforts being made by the government to really lower the cost of feeds, input material for the sector. What do you make out of the sort of sector? And also, mind you, like we've seen, the stocks have been very volatile. Like if you take a look at the 12-month period, these stocks normally are quite volatile. Though the demand globally again has been quite good. From that perspective, what's your view? And do you like any stock in this sector?
So we had seen a lot of volatility in their prices of raw material and all. So because of that, the margins has gone up and down, and also demand factors also works here for these companies because of the international demand, how it is coming. What we are seeing that there was a very good consumer demand from all these developed nations in the past, and now they are coming off in the recent past. So because of that, because of the volatility in the results, these stocks are coming off or going up and all because of that. But apart from that, the effort of the government is more towards supporting supporting these sectors based on whatever the in between shortcomings are there, and specifically in this budget, they had supported with reducing the cost of their raw material, which is shrimp feed, which is been manufactured by a few of the company in India, and for them the raw material cost has been reduced marginally. So that will have some positive impact. Nothing so great, but yeah, some sort of benefit. See, I told you about the budget that nowadays not much changes are there in the custom duties or GST. They are not doing in the budget. They are doing it separately, and then there are some direct tax changes. So, at such the impact on the company from these things are very limited.
Right, and I also want to ask from a consumption perspective, while I again come back to agriculture and ask you something else. From a consumption perspective, when we hear like so much of investment, so much of projects, tax slabs also sort of, we heard like expansion there. It remains a debate whether you want to go into old or new tax regime. But from a consumption perspective, is that something we can play as a theme, like Hindustan Unilever or other consumption stocks? Is that any of those themes you want to play? You're thinking that perhaps more money could go into the hands of rural population because of agriculture stocks. How should we play it?
See, from a recommendation perspective, Hindustan Unilever definitely we have recommended. But based on the parameters of the how the valuations are and how the performance company is doing. But apart from that, if you look at the budget, they had not supported very aggressively to the increase in the consumption. No doubt, some benefit from lowering of the of the personal tax if someone shifted to new regime of income tax is there, but that also not very big, which can come in a long way to support the consumption. So consumption drive is comparatively soft in the budget. Only thing is that up till now, if we see the bottom of pyramid, people are still struggling. They are still below pre-COVID level. Whether you see the two-wheeler buying is still lower than the pre-COVID level, and a lot many sectors, if you see, they are still struggling. So to boost that particular part of the economy, nothing has been done by the budget, and will continue to struggle. But apart from that, if we talk about the overall consumption, even the higher end consumption is also now slowing down, which was very good till festival seasons. Now, if you see the demand in the small appliances has come off very sharply in this year, in this quarter, specifically post the festival season. So uh, demand is slowing down, and that is the intention of even RBI also, and that's why the interest rates has been increased so the inflation can cool off. So it's more of an intentional which is going on, and is on the line. About Hindustan Unilever, yeah, definitely we like that company. It's more of a defensive play, which we were seeing that there is an opportunity of anywhere between 15 to 20% gain in a year, because recently that share got bit corrected because of the event, like the Unilever has increased the royalty by 85 basis points. So what we see that still whatever the royalty they had increased is not very large, and easily can be compensated by new innovative product which can be introduced by the Unilever into the India, and also this can be compensated by improving the cost efficiency here. So, because of this implementation, even after Q3 very good quarter numbers, the stock has come off. But we see that the event has already played out, and now the things can move on a regular basis. Valuations has become attractive because of that, and one can look to invest in this volatile environment in this type of defensive company at attractive price, which can generate around 15 to 20% return in a year.
Yes, and there are two more questions which I want to ask you. One basically is on pipes, and second is on tourism. Pipes, I wanted to ask you because I was trying to imagine agriculture, you need pipes, infrastructure capex, any sort of major project happening, even in urban infra also you need pipes. So is that something where we really sort of should envisage that order book, order inflows should stay strong, and if the execution also stays strong, are we sort of looking at good, strong 2, 3 years of very strong, solid growth? And should we stay positive on the sector?
Yeah, in fact, there are two type of pipes in this. Not only one. One is PVC pipe industry. You have to take it both the things separately, and there is a large scale infra pipe, which is like DI pipe or LSAW, ETSAW pipe and all, which is more of a derivative of steel. So, because of the infra push and this Jal scheme related to water by the government, Har Gal, Har Ghar Jal, that is because of that, which is going on since last few years. It's not the first
Yes.
year where, but the allocation in this budget is also increased, so that can have some positive impact on the demand for this particular business. So yeah, it's more of a continuation of what was happening, but expecting growth, very high growth is not feasible in this. They are growing somewhere at around 10, 12, 15% at an industry level, and a specific company can grow by 15, 20%. So that is happening, but yeah, it's okay. Like you need to play even steel cycle also in these steel company, because raw material prices were very high in the recent past. Now it has come off and now again going up. So that volatility also one need to keep into mind while investing in these type of stock.
Okay, and another one, which is the tourism sector. We saw a couple of announcements being made by the government. Now, uh, there are two parts of the announcements. One, you are talking about constructing new facilities, that takes time. But the second part is where actually you are making the sort of 50 ideal tourism places and putting them as a structured opportunity in front of the domestic tourists and international tourists. So usually what it does is it actually creates higher inflows and also improves the overall utilization of the hotel industry. We have seen how the results have been so stupendous for a couple of leading hotel players. So do you like right now the hospitality sector? Do you believe that perhaps the sort of margin triggers or from a stock attractiveness, is this providing any value still at the current sort of rates?
Yeah, definitely the valuations has moved up in the recent past. And if you see the recent results of these companies, it's mainly driven by ARR, that is room rent. It's mainly because if you compare it with the pre-COVID level, they are up substantially. Whereas the hotel utilization, room utilization are more of at pre-COVID level, or even in some cases bit lower also in some areas. So in that scenario, it's not like everything is doing very well. So if suppose there is some slowdown, as the pent up demand for outing is now getting bit over, and foreign tourists are not so aggressive in coming to India, though they are improving, but not so. Still much lesser than what it was at pre-COVID level. So that is creating some issue in the short term. But if we take from the yearly perspective, I think things will be strong because of the two event which is likely to happen in the year. First is like there will be G20 meetings which will be happening across India in this year, and another there is a ODI cricket World Cup will be happening. So that will again create good demand for hotel industries. And third is that the foreign tourist, if they start picking up and start coming to that villa, that can also improve the utilizations of these hotels. So more of a neutral at current point of time. But if suppose there is good corrections in say next 3 months, then it can become an opportunity to buy.
Right. So that actually rounds up our conversation. For our viewers, let me actually sort of round up the conversation here. We actually are talking about from a sort of fixed perspective. Nirmal Bang basically is picking up Hindustan Unilever from consumption. We also talked about Sangvi movers, where again basically Sunil highlighted why they like it. So that's again a play on construction suppliers. We also basically they also like again basically Alicon Engineering, supply of industrial gears. LNG Finance, we talked about how basically the company changing its business model. So that's another one from NBFC perspective. RBL Bank is being liked, and that we discussed from a budget perspective. And Sunilji, anything else which you want to name from the names I've just picked up as a summary from your side?
See, we keep on recommending different different stocks. We recently even we had recommended a few of the banks also. So Ujjivan small finance banks looks better, and there is some corrections in the prices, so that looks good.
Okay, Sunilji, thanks a lot. You've been patient enough. It has been a long conversation around the budget event, and we have tried to cover all the major sort of triggers in this conversation. Thanks a lot. We really enjoyed talking to you.
Yeah, thank you, Piyush. Thank you very much.
And dear viewers, hope you enjoyed this conversation. With that, it's a wrap on this show. Thank you.
Subscribe to our YouTube channel for in depth interviews of India Inc. and press the bell icon so that you do not miss our updates.